about a 3-decade background where I've worked in high tech the entire time. I started out in disk drives at a company called Quantum, moved on to a company called Teradyne, which is local here, for about 8 years in the semiconductor space. I actually spent a little bit of time doing what a lot of you do. I was a sell-side analyst for 3 years at a boutique firm called Ferris Baker Watts that was acquired by the Royal Bank of Canada in 2009. But I really wanted to be an operator at a company. So I joined a company called Start Networks, and we were public for 3 years, and we were changing the mobility landscape. And that was a game-changer technology. It made the smartphones that we're all using today possible. So possible that Cisco just had to have it for $3 billion. And that's still one of their top 10 transactions out of the approximately 200 that they've done thus far. And I spent the next 6 years there, kind of working through and making sure we were driving that business. But I left because I wanted to go to a smaller company. And I went to a company called Rapid7 here, locally, in Boston. And it wasn't always a Boston company. We had a slide up for a long time that showed the tragedy on 9/11. Rapid7 was named for the Rapid7 train that used to go to the World Trade Center. The company moved to Boston. So as much as it feels like a Boston company today, that isn't how it started. In fact, they're on the lapel of the Bruins. I can't believe they lost. The lapel of the Bruins and most of the stadium. And then I went to Vestmark. I went to Vestmark for 4 years. And that was a good experience at a private company. But I really wanted to get back to the public thing. But over the last 10 years of my career, it's really been SaaS focused. My last couple years at Cisco in particular were about helping the company through virtualization and starting the subscription business there. Believe it or not, in 2015, when I got to Rapid7, a cybersecurity company, they were selling perpetual licenses. So in the front of the public eye, we took that company to a SaaS ARR business that they are today. They're like 95% SaaS today. And lastly, at Vestmark, I joined a company where the founders knew 20 years ago that recurring revenue mattered. But they also were doing gross revenue, not net revenue. So the metrics were all over the place. So we helped repair that. I was excited to get the call from Peter to come and join Evolv. I talked to the board, I talked to the rest of the management team about a year ago. And it's been one of the best decisions I've made. Because I get to lead 50 great people on this team. The accounting and FP&A side, the manufacturing and quality side, IT and sales operations. Two of the people that I work with the closest are in this room today. Nancy Milhouse, our SVP, Chief Accounting Officer, and Brian Norris, who I think you guys have seen a few times today. Now I'm excited to take you guys all through a number of things today. And I'll go through them quickly, because I think the agenda is important for what we want to cover. First, I want to go through our Q1 results. And if you haven't noticed, they were pretty well received in the market. Then I want to go over our 2023 business outlook, which we were also able to raise about 2 weeks ago, and we'll get into the details around that too. I want to look at our business model, and frankly, how that's transforming from what it was into what it will be as we enter 2024. We get this question a lot. What are the economics of your business? So I'm going to do an illustration of the subscription economics, the pure subscription, and we'll also talk about what happens when companies purchase our product. And our expanding relationship with Columbia Tech. We talked about that on the call. I'll get into some details. That's going very well. And now 2 years after being public or going through the SPAC process, it's time to talk about our long-term operating model, because we have our financial ducks in a row at this point. And I'll stop with maximizing shareholder value, and frankly, stakeholder value, for that matter. So we had strong Q1 results, up and to the right on many factors. It was subscription, revenue, annual recurring revenue, and RPO, remaining performance obligation. RPO is becoming a fan favorite amongst many of you, because it shows the power of our 4-year contracts. Not many SaaS companies can boast that. And that number gives prediction, gives insights into what we're going to do in the future. But the number I'm most proud of on here is the gross margins of 27%. Now, in any other day, I wouldn't tell you that 27% gross margins were all that great, but last year we did 3%. When I joined the company, I sat down with Peter, Mike Ellenbogen, and Anil, and they said, what do you think about our financials? And I said, everything looks great, but you have a gross margin problem. So that day we made a commitment to saying, well, we're going to fix it. And it's become a priority at our company to do so. It wasn't something that was going to happen overnight. And I think what I'll talk through today will show you how that's kind of developed and where we're heading. But Q1 was the first insight of that improving and getting to the place that we need to be long term. We're in the midst of a transition right now. We talked about TCV historically, total contract value. That's not what SaaS companies do. They talk about annual recurring revenue. So we've changed that nomenclature in the business. It's the way we talk to our board, our employees, our investors, any stakeholder. It's now ARR. It's how we pay on our bonuses, and it's the only way at this point that we pay our sales force. So in looking at this chart, it's a little bit of the 80-20 rule. About 20% of our customers represent about 80% of our revenue, because we're doing pretty good sized deals with them. We've got 70 customers as of Q1 23 that we're doing over 100,000 in ARR. Another 20 that are doing over 250, and 16 that are doing over 500, and some of those are over $1 million per year. We have a great balance of customers. It's okay if they buy 1 unit, it's okay if they buy 100. They're all equally important to us, as Betsy mentioned in our service model, in our customer. Now, we have a strong balance sheet and cash position. I know 23 weeks ago, we announced we were doing a debt structure with Silicon Valley Bank. We did a $75 million line of credit. The main reason that we did that is because we thought we might have to be more subscription bent than we probably think we do now. The banking industry has gone through a little bit of a hiccup. If you haven't noticed, SVB, Signature Bank, First Republic, I don't know who's next, but it's been in turmoil. So we decided to pay down that debt structure and move on from it. We don't need it right now. We may never need it. But we wanted to make sure that we were letting the market settle and that we were focusing on getting our business to where we wanted it to be. Now, the other thing we did recently is actually light up an investment committee. Most companies have 3 committees. We now have 4. And that investment committee was not set up to just do what's happening over the next 3 months or how are you investing your money. It's more strategic than that. We want to think 3 to 5 years out about the capital needs we're going to have, because all the things you heard from my colleagues today is that we're the human security company, not the Evolv Express company. There's a lot more for us to do. We want to have more products. We want to meet our customers' needs. At some point, we'll need capital to do that. It's not today, and it's not what we need. We can get to profitability without it. But for us to really hit the mark over time, that may be a requirement. Now, we've split the $182 million in cash that we exited Q1 with into 3 iconic banks, almost evenly. And that's all invested in government securities at this point. And right now, government securities are a good investment. They're the best investment for a company like us, and they're yielding about 5%. So let's talk about the business outlook. In Q4, we gave an outlook, and we kept it steady in Q1. In fact, we gave it sooner than most companies do. We talked about exiting ARR of 65 to 70, revenue of 55 to 60, gross margin of 30 to 35%, and adjusted EBITDA of 55 to 60. On our last call on May 10th, we were able to increase all of those numbers. The one that I think surprised the investors the most from what we heard from the feedback perspective is the ARR. Because now, as we're splitting our company into 50% subscription and 50% purchase, there's a bit of a headwind on ARR on those purchase transactions. We'll only get 60% ARR on those transactions going forward. So the fact that we were able to still raise that number, I think shows the power of the pipeline and how we're thinking about the business going forward. Now, we have a highly visible and predictable model. RPO is one of those things. But these 4-year non-cancelable SaaS contracts are very important. We do a monthly subscription, we recognize that revenue monthly, and we bill a year in advance. And as AJ pointed out, we have strong contributions from our channel partners. Why are we going through the channel? Because it reduces sales friction, because it helps us offset some of the costs, because they're part of our service. They're our extension of our sales force. They're bringing deals to us, we're bringing deals to them. It's a great partnership going forward. And what it's helping us do ultimately is compress our sales cycles. Let's talk a little bit about a deal, right? These are the illustrative subscription economics. And the parameters I'll set is that this is for a dual lane system over a 7-year period. We capitalize our equipment over 7 years. That's the life we feel comfortable with. We continue to feel comfortable with that life. Our revenue on that subscription over that 7-year period is $210,000. That assumes we get a 4-year contract and a 3-year renewal. That's $30K in ARR per year. We also have $75K in costs, because on average, it's costing us about $15,000 in customer acquisition costs, or CAC, to go and win that customer. It's another $20,000 over that 7-year period to service that customer correctly. We have CRM, we have service, we are there for them, because we don't just back up a truck and leave a system at the doorway. We actually help them through the installation, through the upgrades, through anything that they need over the course of using that system. Now, the device itself, with the dual lane, if it's an outdoor, can be as much as $40,000, including the installation costs. And that's what we capitalize in our subscription business. The result, the $135K, I'll call it contribution margin, because I have sales in there. It's about 65% in contribution margin in this example. That's about 75% in gross margin. Now, this is an example of a deal. We do about 2/3 of our deals with single lanes, 1/3 with dual lanes. The cost of a single lane, or the price we get for a single lane, is about 25% less, costs less to make, costs about the same to win it, and costs about the same to service it. And that's why we talk about 60% plus gross margins in our service business. And that's where we're heading towards. So we've had 2 very different business models. Pure subscription, we rent the hardware, we rent the software. The hardware that we're renting is a fixed asset to the company. It's on our balance sheet, we own it, we're out there servicing it. No problems with gross margin there. It's okay. The purchase subscription method we've been using, or the legacy method, is running it through our books. And that wasn't working. And you'll see that in a couple slides, just how much it wasn't working. And that was the core reason why our gross margins were not at all matching the power of what the company was doing, or even the deals we were doing. We were doing deals at 55, 65, 70% margin sometimes. But I can't print it with the way that works. Another point, we are a hardware design company, and we are a software company. We are not a glue the product together company. So allowing that to kind of sit in our books that way was not productive for us. So we went to work, and we figured it out. And so we're introducing a new way forward, which is an extension of our relationship with Columbia Technology. Columbia Technology is the contract manufacturer that we've been using since the inception of the company. They have become the non-exclusive distributor of Evolv Express for any customers that want to purchase the asset. And the best thing about this is that the way we've designed it, and it will go through our channel partners, there is no change to how the end customer is going to see this that's going through the channel. And I'll talk a bit more about that. It'll change how the channel operates, but it won't change how the end customer sees things. This model will actually allow us to have higher gross margin, higher EBITDA, and lower cash usage. And I'll say today, we think we're going to achieve EBITDA break even in the first half of 2025 with about 75 to 100 million in cash still in the bank. That's about 6 to 9 months earlier than anything we had said before. So we're taking that in, and there's potential for upside there. It really depends on the mix of what we sell in terms of pure subscription and purchase subscription going forward. So who is Columbia Technology? Well, I think a picture is 1,000 words, so I want to put this up quick. This is actually the team that builds our systems, and that's the 3,000 system that came off the line last quarter. It's a very professional organization. It's clean. They do our final assembly and our tests, and they've been a true partner to us since the inception of the company, like I mentioned. They're a 4th generation company, like Peter mentioned earlier in the day. They have about 800,000 square feet of space locally here, 1,000 employees, and work with some very large name customers. Amazon Robotics, Applied Materials, HP, Dell, Markforged, Haemonetics, Hologic, and Evolv. We're one of their top 10 customers. Last year we were 8% of their business. This year we'll be probably 12% of their business. So it's well diversified from that perspective. This is a well-oiled, family-run machine, and we had a lot of trust in them to do this. And when we looked around at doing a hardware distribution model, we looked around hard. And this is the best situation we could find. They wanted to go up the value chain to help us. By the way, they're also a sponsor out in left field there. The Coughlin Company is next to Vineyard Vines. So let's talk a little bit about how the Columbia Tech situation is going to work going forward. How our hardware distribution model is going to actually be perceived. Let's take the end customer, Six Flags. Six Flags might want to buy the systems. They might want to rent the systems. They don't care. They're going to talk to the channel partner, Securitas, Johnson Controls, perhaps Motorola. They're going to go there at an MSRP of 185 and actually negotiate with them. They might want to buy it. They might want to rent it. Well, one of those channel partners actually has a discount off of MSRP, call it 30%. And so they end up paying us, typically, or in the past, in history, it would be 129K order, split between hardware and software. Now, going forward, they'll be actually bifurcating that order into 2 POs. A purchase order direct to Evolv for just the software portion, the 75K. So approximately 60% of the order is actually software driven, and 40% is hardware driven in this model. So that 129 is a baseline. What they end up doing, because we have another agreement with Columbia Tech to actually allow them to sell our product, and they set the pricing, they do everything there, they look for guidance, but they're the ones who are actually setting what they need to do. But we have actually entered into that with them, a very fixed license fee. And that license fee, in this situation, is about $14,000. So between that 75K in software we're going to get over 4 years, and the $14,000 that we're going to get in a one-time license fee, we're looking at stuff that is 100% product margin and about 80% gross margin. So the combination of those two are very powerful to our business going forward. We'll get $89,000 over the 4-year life of the contract based on this deal. Now, let's talk a little bit about Express 1.0 and 2.0. As I know many of you have heard that we're actually doing a lot of engineering work around our second product. And our second product isn't a big change. We've added a few bells and whistles to it, but largely the product is a reconfiguration of our old product. It's built for modularity, for quality, a lot of things that we've learned over the past couple of years, like weather and heat and water. All that stuff has been built into the system. It's going to be easier to service and easier to build in the end of it. And the best part is 2.0 is going to be cheaper. So with Express 1.0, that's the current situation I'm talking about, where there's 75K, which turns into 19K ARR and a 14K license. So we're getting about 70% of that total contract value. Again, this is why our ARR is slightly lower. We're getting about 60 cents on the dollar in ARR. In Express 2.0, assuming pricing stays the same, we have the opportunity to recoup a higher license, as much as 25K on this similar deal, if the costs come down like we're planning, and we are on track for that right now. And the costs we would expect to see are 30% plus. So let's talk about how gross margins are changing. The best way to do this is to look back at 22 and forward to 2024, because 2023 is the transition year. In 2022, I told you our gross margins were not what they needed to be. They're at 3%. And it's because we had 58% of our revenue coming through the product line at negative 30% gross margin. Because we had to take all the costs up front, we had to pay for all the service, and a lot of the revenue was done through a cost-plus methodology. Then there's our subscription business, which was only about a third of our business last year. In fact, we did more purchase deals than we did subscription, and it prints out here at about 32% of our business. Pricing's gone up over time. That 57% is reflective of 3 price changes last year. Our prices are higher than that now. That's why I'm talking about 60% plus in the subscription lines. And lastly, the service line. Very confusing. There is installation in that line, shipping in that line, and all of the ARR, or recurring revenue, that was associated with the product sale. So we were confusing just about everyone we talked to by going through it this way. It was really hard for people to understand how to kind of model out things other than just a high level number. And if you're trying to do it from the bottoms up and you're trying to use this method, it just wasn't working. We heard you. We got it. We needed to fix it. So we are fixing it. And next year, you're going to see our revenue look more like this. Product of about 5%. Because we're still going to sell demos from time to time. We still sell tablets, some piece parts, and occasionally we'll sell a system if the customer absolutely needs it a certain way. That gross margin will still remain very low. Where the meat of our business will be is in the subscription line and the service line. Because when we sell our product as a subscription, a pure subscription, we're renting the hardware and the software. That all goes in the subscription line. When we go through the CT deal and we get a PO for the subscription portion of that deal, that goes in the subscription line. What will now go into the service line is the licensing revenue from hardware that we get. And any legacy revenue that's sitting in our RPO related to any of the legacy sales. That will meter out over the next 2 to 3 years. But most of what's in there is service. Now, lucky for us, we're moving from a 39% ARR business in 2022, you'll wonder why we talked about TCV more, to an 80% business in 2024. We expect 80% of our business to be annual recurring revenue and approximately 20%, 15 to 20% to come from licensing going forward. Now, a lot of SaaS companies have an ARR component and a service component. And that service component is oftentimes a 30 or 40% margin. Our margins on our license component are almost equivalent to what our subscription business is. So I like to think we can look at most of our revenue on the same basis going forward. It just doesn't have to be an ARR metric. I think all of our revenue has equal power because of that result. Ultimately, we feel comfortable saying that we think we'll be a 60 to 70% margin company because the pure subscription business will be 60% margins and that purchase methodology will be closer to 80%. And it'll just be the mix between the two, which we're now planning on about 50-50. But if it goes 60-40 one way, 40-60 other ways, it'll impact the mix. But one way or the other, we think it's around 50-50 at this time. So it's important for us now to introduce our target operating model. We're comfortable saying that over the next 5 years, we think our top line growth rate is 30 to 40%. All the modeling we've done, all the work we've done, give us the confidence to say that to you today. We also are confident to say that we'll get to profitability in the first half of 2025. And we'll achieve that 10 to 15% EBITDA profitability. You know what happens when those two numbers get added together? You're in the rule of 40. Rule of 40 plus is the goal of our company. The more powerful part of the rule of 40, obviously, is the top line growth. So we will invest and sacrifice. If we think we can grow more than 30 to 40, that 10 to 15% might come down a bit to the benefit of that top line. But being rule of 40 plus is going to be something we need to do. I just saw an analyst report this morning with a headline for Palo Alto was rule of 40 plus is still there. People care about rule of 40. Now, the rest of this is about us achieving scale economies in our business. R&D. We think we can settle R&D out to 15 to 20%. Now, we may leak up to 25 if we think there's something really compelling to invest in, but I think it's a 15 to 20% investment based on what we're seeing today. A lot of that has to do with the fact that today, 50% of our R&D spend is on reconfiguring our 2.0 system or redesigning it. That's spending that's going to stop pretty soon. We're going to spend about $15 million over 18 months ending this year to redesign our system, which is why we want that higher license fee. But you know why we did it? Because our projections next year for units would say that with the cost down that we are getting, we're going to get a $50 million savings in the product cost. That $15 million that we're spending has an ROI that gets there in about 4 months. Now, in terms of sales and marketing, that is where we're putting chips right now. We're building out the channel. We're building out our AEs, the service model. We spent $100 million historically in R&D. We built this product. Now we got to get it to market. So that is where many chips are going. But we do think this potential through scale and working with the channel, that kind of tops out at the 25 to 30% level within the 5-year period that we're talking about. In G&A, we're public now. We have a lot of costs. We have insurance, accounting, legal, NASDAQ, SEC, and all the people it takes to be a public company at this stage. Best thing we ever did was a SPAC. We were able to raise that money at that time to help us get to the promised land that we want to get to. But we had to be public sooner. So our spending in G&A looks high, but it's a skin that we have to grow into. And we will do that. And I expect that by the time we grow into that skin, it'll be about 10 to 12% of our business. So let's talk a little bit about maximizing shareholder value. Because over the past year, and I know my colleagues have heard it for almost 2 years, there's a number of myths out there about who we are as a company. The first myth is that our market size, our ability to penetrate it, and our compound annual growth aren't real. I hope you heard today that is a $20 billion TAM, and we're pointed right at 18 billion of it. We're not focused on airports, we're not focused on jails, we're focused on the rest of the 18 billion. And right now, all of our G&A spending is pointed at about a third of that 18 billion through account-based marketing, through digital marketing, through the channel, and through AEs that are doing good old-fashioned cold calling. That's how we're attacking the market. And it's not random. We're going after the parts of the market where the biggest gun violence problems exist. Second myth, we're a one-product company. We're not the human security company. We're the human security company for a reason. We're not the Evolv Express company. I think you've heard about the things that we're thinking about beyond this. Peter put up at the beginning of the day that we want to have a portfolio of 5+ products. That's our next milestone. We have plenty of ideas in the back room. We're not ready to talk about them all today, but we fully expect that what our customers are asking us and our ability to harness data and the digital footprint that we're looking at will give us a way to get other things done. Let's not take away. Evolv Express is our flagship product right now. That's what we're focused on getting out there, but we're thinking about other things we can do for our customers, both inside and outside of the venues. Next myth, increasing competition. Look, we're not naive enough to think that if we're doing well, someone's not going to come after us. We watch that hard. But what we've seen so far is old analog companies adding a few more bells and whistles and dropping off their product, and a couple of other products that actually look more like our original Edge product out there. No one has done what Dr. Alec Rose and Mike Ellenbogen has shown you before. We have a healthy head start, and we're going to take advantage of that. So we will run into some competition. It's generally on pricing, but you get what you pay for. The next is constraints related to our target operating model. This was a bigger problem when we were 3% margins, but I think the fact that we showed 27% in Q1 and we gave higher guidance, and I'll tell you that I expect our gross margin to go up each of the next 3 quarters this year, that we're outweighing this concern that our target operating model isn't going to work. And lastly, we're a hardware company. Everyone runs into a piece of hardware and they see Evolv on it. We are a software company and a hardware design company. Right? Every SaaS company runs on hardware. They just pay AWS for it. We designed our own. Someone else builds it for us. They even deliver it for us. So what I'd like to do is recap on some of the key messages you heard today. We are creating a new category out there. There's no doubt about it. There's a greenfield market out there. And when you talk about using security as something that can help people, that's really where we're heading. It's unlocking what couldn't be done before. We're in a large and underpenetrated market. I'm not worried about the size of the market. I'm worried about the size of our sales and marketing budget so we can go get the market. That's what we have to be, because we have a finite amount that we can spend there. So we're trying to spend it as smart as possible. And a commitment to product innovation. We just hired Parag Vaish. We have Mike Ellenbogen. We have Dr. Alec Rose. We have Ovasis Hassan. We have people thinking about this every day. Our commitment to product innovation is clear. Creating customers for life. We want to make sure that our customers are happy. It's important to us. You just heard from 2 of our customers, and I think Anil made the point that if you put 2 other customers up there, it would be the same result. Betsy showed you how we approach a customer. That isn't what happens in the physical security industry. We're changing the game there. And sustained long-term growth and profitability. We can do good things in the world and still run a profitable company, and that's what we're going to do. I'm really proud to work at this company. I work with some of the most talented people out there. I can say that after you've met with everyone here today and what you've seen, that we got this, and it's going to be a fun ride to be on. Thank you.